Hello, everyone, and welcome to our next technical analysis review for the Euro US dollar pair. Today is March 6, 2012, and we are currently looking at price action on our 10-minute chart. And as you can see, the major theme for today was risk aversion. We're seeing dollar strength kick in, and there was this bearish bias in the market due to a number of different factors. For one, there's still fears over the Greek PSI deadline on Thursday and whether Greece will receive the recommended participation rate among private bondholders in order to receive their second bailout package. So, of course, this weighed heavily on the Euro US dollar pair, but we're also hearing news about global growth fears and signs of recession in the Eurozone. Of course, they came out with the revised GDP numbers and also the low PMI numbers that are also weighing heavily and putting pressure on the pair. So of course, for most of the day, it's been risk aversion, and we've been seeing dollar weakness, or I mean dollar strength, excuse me, and weakness across multiple asset classes. And we may continue. Sorry about that. And we may continue to see more risk aversion until the market finds some reason or some sort of reason to be confident again. So on today, we saw the Euro US dollar pair slide 123 pips from the session high up here at 32.26 down towards psychological support at 3100. And right now the market is consolidating ahead of the Asian Open. Now, if you were looking for an opportunity to enter short or sell the Euro US dollar pair, then you could have done it right after the London Open when price pulled back and retraced up to this 3200 psychological zone. You could have placed a sell order here upon bearish confirmation and took your profit near this 61.8% Fibonacci retracement level, which was formed from the recent rally up. Let me go to the 3-hour chart so I can show you that this, like on this 3-hour chart, you can see that the 61.8% level right here where my cursor is was formed from this recent rally that began and started on February 16th at 29.74 all the way up to resistance at 34.87 on February 24th. So this formed this Fibonacci retracement, the 61.8% Fibonacci retracement, which could have been a good area to take our profit. But let me go back to the 10-minute chart. So if you would have took your profit at this 61.8% Fibonacci zone at 31.68, it would have resulted in a 30 pip trade. Or you could have held out onto your trade. You could have maintained the bearish bias and held out onto your trade and closed it when it reached this intraday support at 31.30 for about a 70 pip trade. So then, of course, that was one entry you could have entered prior or after the London Open. You could have entered at the 3200 psychological zone, and you could have held your trade out and closed it for about a 30 pip or a 70 pip trade. Now, if you were looking for another opportunity to re-enter the market, you could have done so when price retraced from this level and retraced up to this resistance at 31.60, which was actually yesterday's low, was the low from March 5th. So then if you were in front of your platform at this time, you could have entered a sell order at this price at 31.60 upon bearish confirmation and took your profit when price reached support at 31.14 for about a 46 pip trade, or you could have held on to the trade until price eventually reached this psychological zone around 3100 for about a 57 pip trade. So you can see that these two locations at the 3200 area and also the 3160 level were two trade entries that you could have placed for today. So then right now, like I said before, after this strong drop, the market is going through a consolidation ahead of the Asian Open, and we may continue to see more downward pressure in the pair ahead of Thursday's ECB meeting and also Friday's non-farms payroll report. So that's it for our technical analysis review for today, and I will be talking to you guys later. You guys have a wonderful time. Okay, bye.